Thinking about common prosperity, what does that mean? It means a couple of things. We think high margin companies are on the government's radar.
DD is a poster child of what is not. Is perhaps the prime domestic driver of common prosperity.
When investing in Chinese technology companies like NIO, you'll know about the China tech crackdown and one phrase which is the most important one currently, which is common prosperity. So in this video I will be playing two clips about common prosperity. One by Cathie Wood, who has recently invested in NIO and also XPeng, and her views about common prosperity. And the second clip will be by a government advisor, and then I'll give you like kind of my views around it.
So as we were pulling out of China largely, thinking about common prosperity, what does that mean? It means a couple of things. We think high margin companies are on the government's radar, you know, and as this idea of common prosperity, cut your margins to increase access. So we're looking for very low margin companies, not normally what we look for.
That won't have big targets on their back.
Yes, that won't have, but are going to increase the access to transportation.
So this view by Cathie Wood gives you a very kind of easy investment advice, right? If investing in China, then make the distinction between high margin and low margin. I already gave you my views in the past that I don't think even NIO is a really low margin product, but if you compare it, for example, to software companies, then yeah, you can make the case that everything in automotive currently is actually very low margin. And so this argument kind of could make sense, right? But now let's have a look at another take here.
DD is the poster child for President Xi Jinping's vision of what's called common prosperity, which has many elements, two of which, probably the most important, are what's called the disorderly expansion of capital, which is a broad term. It can be utilized very much across the spectrum, but has as its focus the platform companies, of which, of course, DD is a primary one, because it relates to the relative power in the economy and society of these companies versus the party, the Communist Party of China, the CPC, which is the perpetual ruling party of China. And because of the expansion of so-called expansion of disorderly expansion of capital, these platform companies have had much more impact in society. So this is a reversal of that. The second point is how they treat their workers, the gig workers, because this has become a major factor in Chinese society. How to balance the imbalances between urban and rural ownership and workers, inland and coastal regions. Common prosperity was derived after China achieved what for almost 10 years was a prime objective of Xi Jinping, which was to eliminate all extreme poverty.
So Robert Kuhn, who is actively advising the Chinese government, is bringing up 2 points. The first point is about power. He says that these technology platforms in particular, like Didi, have become too powerful in how they are influencing society, not only in an economic way, but also in terms of values. So this is a pure power play. The second point that he is making is about the way these platforms are kind of trying to exploit workers, or how they are dealing with them and how they are treating them.
An important factor that I should stress in common prosperity that China says, it is not to Robin Hood and take from the rich to give to the poor. It's not to create a welfare state where everyone is equal. That's not the intent at all. Because China recognizes, Xi in particular, that entrepreneurship, energy, the market allocating resources is absolutely essential for China to achieve its great rejuvenation by mid-century. So that's a critical factor. So each individual question needs to be evaluated by competing objectives. And China does want to open up. It does want its companies to be prominent in the world. China has a global initiative for development that it wants. It wants its companies to do it, but it still has other issues. It wants to be absolutely sacrosanct in controlling data. It doesn't want its data outside. And so, given a choice, if one has to make a choice between market success and security as China would see it, they will always opt for security. And security for the party to maintain its leadership is number one.
And so here's my personal take. I do think, well, in a way, this approach by Cathie Wood is to, looking for low margin business could provide some sort of a safety, because of course, companies that have higher margins, they may have them because of a reason, and that reason may ultimately that they have been exploiting workers, for example, or exploiting society in general, or have maybe not adhered to some rules and regulations that possibly haven't been in place to start with in the beginning. So now these regulations are coming in, and I think it will affect companies that are exploiting value in contrast to actually creating value. That's the distinction that I'm making. And this is, well, maybe this can be seen in margins, but I would really argue that you can invest in high margin businesses in China that are possibly not even at target of the Chinese government. I would even argue once again that NIO is and will be a high margin business, at least relatively so, because of course it's a premium to luxury provider, so they will have ultimately higher margins than, let's say, an XPeng, which has low margins. And I also see like NIO can actually turn up with services like e-commerce, value-added services like autonomous driving, which will ultimately also result in higher margins. And so once again, for me, the distinction comes to exploiting value versus creating value. And I think NIO really is a company that is creating value, and also value in a sense that China likes to see it, right? It's green, it's sustainable energy, it's in the area of manufacturing, so it's real economy, and it's also not exploiting their workers, quite to the contrary actually. And they're not known for those, let's say, bad working conditions or exploiting with their business model some loopholes in society like Didi has done. So this is, I think, one of the distinctions to make, and one of the key takeaways. An easy way of approaching that might be actually to look for lower margins, but actually I think there might be even companies at stake that have low margins and are still exploiting some of those workers, for example. And if considering this, I think this term of common prosperity shouldn't be something to really scare investors off, and in the long run may actually provide some very sustainable and long-term growth. And that's exactly also, I think, where China is looking at. Of course, sometimes this is very unpredictable to know. For example, investors into the educational field have been really caught on the blind spot here. However, even investors like Baillie Giffords have said, like, in retrospect, we should have known that this is an issue there. Anyways, that's for a quick definition. Please let me know your views in the comments, and then thank you guys for watching, and see you in the next one.